All right, let's obviously stay on the jobs report here and bring in Emily Roland, John Hancock, Investment Management Co-Chief Investment Strategist, and Anthony Chan, former Chase Chief Economist. Good morning to you both. Emily, let me start with you here. Jared pointing out some interesting moves in the markets off of the jobs report, spike in the NASDAQ. What's your take on the jobs report, and why do you think, at least in the early going, investors appear to be gravitating to the high growth NASDAQ?
Yeah, it's a sharp contrast to what we've been seeing in reaction to the economic data, which has come in weaker than expected over the last few weeks. Today's report looks to be signaling that maybe bad news is actually bad news. So we saw that bid for the 10-year Treasury at the margin about 130 before the report, now around 128. I think that weaker dollar is a really important element that you pointed out, and that's something that we expected to see if we saw a weaker than expected report this morning. And that's something that could actually continue to be beneficial for risk assets here. In those periods of weaker dollar environments, we've seen a surge in risk assets. So that's an important underpinning there. Definitely lower rates, seemingly better for the growth complex, seeing that in the reaction of the NASDAQ versus the Dow. So a big surprise here in terms of the weaker number. The whisper was that we see a lower than expected number, and I think certainly maybe it's even worse than expectations coming into the report.
Anthony, the big question here, what we were talking about ahead of this report, is what this means for the Fed just in terms of a taper timeline. Do you think it's weak enough in order for the Fed to potentially delay tapering until sometime in 2022?
Oh, sorry, that was back to me.
Oh, no, sorry, that was to Anthony. Anthony, did you catch that question?
Oh, yeah, of course. When you look at what the Fed has said already is that they are going to do the tapering before the end of the year. At this stage, even my pet iguana knows that the Fed will be tapering before the end of the year. What this report does is probably take that issue away from September and pushes it into the next FOMC meeting in November. But I have no doubt that tapering will begin before the end of the year. The question is how much and how severe that tapering will be. That will be dictated not only by this employment report, but by the next one also.
Anthony, our Jared Blickery is flagging the leisure and hospitality sector showed zero net job creation in August. I know this was a sector that you were watching coming into the report. Break it down for us. What's happening in this space? Is this just the effect of the COVID variant?
There's no doubt that that was the big surprise in this report. That leisure and hospitality component that the market was expecting about a 350,000, maybe as much as 400,000, turned out to be zero. And in fact, in work that I've done finds that in the last couple of months, more than 50% of all the private payrolls were coming out of leisure and hospitality. So that tells you that there was a reluctance on the part of individuals to come back to work as the surge in the Delta virus actually occurred. But there was another big surprise, Brian, and that was, of course, those employment jobs in the government sector, those education jobs. Everyone was expecting that number to be around 150 to 200,000. And once again, the government component came in very low, basically almost unchanged. So you got two big misses. You got a big miss in leisure and hospitality. You got a big miss in the education jobs. Offsetting that, Brian, was upward revisions in the prior 2 months. And that, of course, you have to add it to this number. And so when you take all these things into account, this report was weak, but not as weak as the headline would suggest. And if you want one last thing, and that is take a look at the household survey used to compute the unemployment rate. Employment went up by close to 500,000 in that report.
Emily, when we take a look at this weak number, it's not because employers aren't working to attract employees. We've seen a number of large companies come out over the last several weeks announcing plans to hire. I guess, what do you blame this on? Is it all because of the labor shortage?
I think that's part of it. Stimulus checks and other pandemic aid have caused workers to stay on the sidelines to some extent, potentially waiting for a better opportunity. So we might see the expiration of these unemployment benefits, which happens next week, bring people back into the workforce. We're also seeing the spread of the Delta variant being a significant element here. causing that sort of delayed reopening. We're seeing a lot of the high frequency data that we watch, things like open table reservations, airlines, hotel reservations, not falling off a cliff, but certainly leveling off here as this renewed impact of the virus starts to affect the economy. So growth in the U.S. is solid. It's continuing to unfold as far as this new economic cycle goes, but we're seeing certainly peak economic data, peak macro tailwinds behind us now. And now we've got to contend with a challenging growth backdrop here. And that's got big implications for the Fed as far as what they're going to do next at the September meeting.
Absolutely. And it should be noted, too, all summer we've been looking for a million increase headline jobs number. We actually got that here. An upward revision to July put July jobs numbers over 1 million. So we got that white whale of a report, but it probably doesn't matter here. All eyes are focusing on this worse than expected August jobs